We're ready. We're back. Thank you again for investing in yourself and purchasing my course. I really appreciate it, and I hope you're learning a lot. I put a lot of effort into this, although a lot of this is all just from a site called Investopedia, which is exactly what you need to know when it comes to investing in the stock market. That is a great place to go and just, peruse through what's available. And it's all free. It's all free. But since it is free, then I get to, you know, recite what I read or what I see and share that with an audience that I create. Right? That's what my company teaches you how to do, is set up the foundation of an online business. Foundation basically means you understand the terms, the definitions, the language, if you will, that's spoken in that particular arena, right? Whatever that topic is or whatever that subject is, you understand that. And when it's spoken, you understand what's being said. Right? Just think about, like, if you want to learn to play baseball for the first time, there's a language that's spoken in that, right? If you don't know that language, it's not easy for you to actually, process or strategize what you need to do to be successful in that particular arena. Am I correct? Right. All right. So what I'm gonna do with this one, like I said, I've been going a little bit long on these, and I think it's just, it benefits you because you also going to be in front of the camera, sharing your content. So when you see me in front of the camera, processing the information that I've researched and want to share with you guys, then you can say, well, I need to stop moving my hands so much, or I need to kind of sit up straight. And you don't have to do all that. Well, how you want to do it? It's the information that's valuable, right? I can have my back to you and be talking. As long as you're getting the information, it doesn't really matter. That's just aesthetics. But yeah, you want it to look in a way, because you want it to look professional, as professional as you possibly can do it without hiring other people to, do the camera work and all that. And all that's not necessary. So, this, as you know, this course, this particular episode is called "When to Sell a Stock," and this is very important because all that's involved in the strategic process that you want to make sure that you format for how you want to invest. Now, the way I invest is probably going to be different than the way you invest, and if not, that's okay. But I know how I invest, right? I know what needs to be in place, what research I need to do, and you'll learn that as well. Okay. So we're going to start it off by saying, again, this is titled "When to Sell a Stock." Now, theoretically, the ability to make money on stocks involves two key decisions: buying at the right time and selling at the right time. In order to make a profit, you have to execute both of these decisions correctly. The return on any investment is first determining by the purchase price. The purchase price. One could argue that a profit or loss is made at the moment it's purchased. The buyer just doesn't know it until it's sold. However, while buying at the right price may ultimately determine the profit gained, selling at the right price guarantees the profit, if any. Make sense? So if you don't sell at the right time, the benefits of buying at the right time disappear. Now, many investors have trouble selling a stock, and sometimes the reason is rooted in the innate human tendencies toward greed. However, there are several strategies that you can use to identify when it is and when it is not a good time to sell. The most important thing about these strategies is that they attempt to take some of the human emotions out of the decision-making process. There are generally three good reasons to sell a stock. First, buying the stock was a mistake in the first place. Second, the stock price has risen dramatically. And finally, the stock has reached a silly and unsustainable price. Now, while there are many other additional reasons for selling a stock, they may not be as wise of an investment decision. So let's go into another segment we're going to call Selling Stock is Hard. Keep that in mind. Selling stock is hard. And here's a all too common scenario. You buy shares of a stock at $25 with the intentions of selling it if it reaches $30. The stock hits 30 and you decide to hold out for a couple more gains. The stock reaches 32 and greed overcomes rationality. Suddenly, the price drops back to 29. You tell yourself to just wait until it hits 30 again. This never happens. You finally succumb to frustration and sell at a loss when it hits 23. In this scenario, it could be said that greed and emotion have overcome rational judgment. The loss of $2 a share, but you actually might have made a profit of 7 when the stock hit its high. These paper losses might be better ignored than agonizing over, but the real question is is the investor's reason for selling or not selling. To remove any human nature from the equation in the future, consider using a limit order, which will automatically sell the stock when it reaches your target price. You won't even have to watch the stocks go up and down. You'll get a notice when the sell order is placed. Okay? Now that simplifies that after, you made a mistake and decided to get greedy, right? So the next segment we're going to talk about is sell stock when buying was a mistake. Now, presumably, you put some research into the stock before you bought it. You might later conclude that you made an analytical error and you realize the business is not a sustainable investment. You should sell that stock, even if it means incurring a loss. You see, the key to successful investing is to rely on your data and analysis instead of Mr. Market's emotional mood swings. If that analysis was flawed for any reason, sell the stock and move on. The stock price might go up after you sell, causing you to second guess your decision. Well, it's also possible that a 10% loss on that investment could turn out to be the smartest investment move that you made. Now, of course, not all analytical mistakes are equal. If a business fails to meet short-term earnings forecasts and the stock prices goes down, don't overreact and immediately sell, assuming if the soundness of the business remains intact. But if you see the company losing market share to competitors, it could be a sign of a real long-term weakness in the company. This is just information that's going to be helpful to you down the road. Now, following that, we're going to go into a segment called Sell Stock When the Price Rises Dramatically. Sell stock when the price rises dramatically. Now, it's very possible that a stock you just bought may rise dramatically in a short period of time. Many of the best investors have the most humble investors. Don't take the fast rise as a affirmation that you are smarter than the overall market. It's in your best interest to sell the stock. A cheap stock can become an expensive stock very fast for a host of reasons, including speculation by others. Take your gains and move on. Even better, if the stock drops significantly, consider buying it again. If the shares continue to increase, take comfort in the old saying, no one goes broke booking a profit. If you own a stock that has been sliding, consider selling on a so-called dead cat bounce. These upticks are temporary and usually based on an unexpected news. Got it? All right, next we're going to talk about what is a dead cat bounce. I just told you to sell on a what's called a cat bounce. Let me share what that is for you. A dead cat bounce is a temporary short-lived recovery of asset prices from a prolonged decline or a bear market that is followed by the continuation of the downtrend. Now, that may be a little difficult to process right now, but as you continue to follow this process, it'll make more sense. Now, frequently, downtrends are interrupted by brief periods of recovery or small rallies during which prices temporarily rise. The name dead cat bounce is based on the notion that even a dead cat will bounce if it falls far enough and fast enough. It is an example of a suckers rally. It's called a suckers rally. Have you ever heard of a suckers rally? Well, good. Let me tell you what that is. A suckers rally describes a price increase that quickly reverses course to the downside. And sucker rallies often occur during a bear market where rallies are short-lived. And sucker rallies occur in all markets and can also be unsupported based on hype, not substance, and rallies that are quickly reversed. Following that, we're going to talk about sell stock for valuation. Sell stock for valuation. Now, this is a difficult decision, part art and part science. The value of any share of stock ultimately rests in the present value of the company's future cash flows. The valuation will also carry a degree of imprecision based because the future is uncertain. This is why value investors rely heavily on the margin of safety concept in investing. Now, a good rule of thumb is to consider selling if the company's valuation becomes significantly higher than its peers. And of course, this is a rule with many exceptions. For example, suppose that Procter& Gamble is trading at 15 times earnings, while Kimberly-Clark is trading for 13 times earnings. This is not a good reason to sell Procter& Gamble, considering the sizable market shares of many of their products. This is not a good reason to sell Procter& Gamble, considering the size of the market share of many of their products. Another more reasonable selling tool is to sell when a company's P/E ratio significantly exceeds its average P/E ratio over the past 5 or 10 years. For instance, at the height of the internet boom in the late 1990s, shares of Walmart had a P/E of 60 times earnings as it opened up its first website with e-commerce. And despite Walmart's quality, any owner of shares should have considered selling. The potential buyers should have considered looking elsewhere. When a company's revenue declines, it's usually a sign of reduced demand. First, look at the annual revenue numbers in order to see the big picture, but don't rely solely on those numbers. It's also a good idea to look at the quarterly numbers. The annual revenue numbers for a major oil and gas company might be impressive annually, but what if energy prices have fallen in recent months? When you see a company cutting costs, it often means that the company is not thriving. The biggest indicator is reducing headcount. The good news for you is that cost cutting may be seen as a positive, at least initially. And this can often lead to stock gains. This shouldn't be seen as an opportunity to buy more shares, but rather as a chance to exit the position before any subsequent plunge in value. Make sense? All right. So the final segment I want to talk about on that is sell stock for financial needs. When you decide to sell stock for financial needs. Now, this might not count as a good reason to sell a stock, but it's a reason nonetheless. Stocks are an asset, and there are times when people need to cash in on their assets, whether it's a seed money for a new business, paying for college, or purchasing a home. This decision depends on an individual's financial situation rather than the fundamentals of the stock. So with that, the bottom line is any sale that results in profit is a good sale, particularly if the reasoning behind it is sound. And when a sale results in a loss with an understanding of why that loss occurred, it too may be considered a good sale. Make sense? Outstanding. I'm glad you were able to process that with me because, like I said, a lot of times I'm learning this for the first time as well. And a lot of times I'm reading this, I'm reading it for you guys for the first time as well. So there'll be things that as I'm reading, I'm processing it, and then certain things may not make sense. And then I'll have to read it again. And that's okay because that's what we're here to do. I'm here to show you that it's okay for you to make mistakes as you grow. It's part of the process, but you get better as you continue on, right? And you're creating an income and you're creating what's called a lifestyle that you get to live and you get to grow based on your effort and your input into what it is that you're doing, right? And with this being an online system, it can all be done pretty much from home or anywhere you go. You can travel the world and just set up your laptop, create your videos, create your products, talk to your audience, sell your merchandise, whatever it is that you have. And before you know it, life is different for you. And it's a beautiful thing. All right. So with that, I really appreciate you again investing into who you are. I appreciate you watching my videos and purchasing my courses. And again, my name is Larry James. My company is Speak with Larry, no spaces. And as always, share with someone else what I've shared with you.